So Malcolm, I've been thinking about how just saying the magic word, good or bad, can really help or hurt you. Was traveling for a wedding this weekend and was renting a car at the Boston airport. And we had rented a mid-size, it was like one of the lower tier ones, like mid-size Toyota Corolla or similar. And we're in the garage. We're with the guy who's going to take us to our rental car. And I just go, oh yeah, we got the mid-size or better. And there's kind of a dead pause. And I go, oh, how's your day going? And he goes, that was really nice of you to ask. You can take any car you want. And my wife goes, wait, are you wait, what? Like, are we going to be trying? And I'm like, you just chill out. And he's like, no, that was really nice of him to ask that. And I have the discretion to choose. So we end up taking this like brand new Hyundai Sonata hybrid that has like 8 miles on it. And it was all because I just asked this guy how his day was going. So I think he may have had a rotten day, but I was just thinking there are times
they always have a rotten day.
What?
In that job, I think they always have a rotten day.
I think that's correct. I think it's very difficult to be on your feet, dealing with people arguing, explaining that they have to pay more money than they wanted to, or try to sell insurance at the same time.
Or like they're pissed off at you because their car isn't ready, even though they just made the reservation while they were on the airplane. Or it says, or similar vehicle. And they says, this is not a Toyota Camry. And they're like, it says, or similar vehicle. And they're like, I don't care. I wanted a Camry. Like, I think their whole day is full of people yelling at them and being agitated because it's hot outside and their kids are crying and whatever. And so you might literally be the only person in the last 30 days who's asked, like, how's your day going?
That's it. So anyway, I was thinking that more. There are times I've had in life where just saying the magic word can really help or cost you, and you may not know it. So the financial tie to this is when I left a job, and this was like 6 years ago. This was a while ago. I think 5 years ago. And as I was doing my 401k, moving a 401k to an IRA, I was just on an online forum, and there's very little information on there other than the question, do you want to take a distribution or do a direct rollover to an IRA? And one of those options, the distribution, means I have to come up with 20% of the value of my IRA during the rollover because they're going to withhold the other 20%, which if you can't do, then you've made a distribution which comes with taxes and penalties. So it's a huge financial mistake to do that. And a direct rollover just means they write the check directly to the company and there's nothing you have to do beside that. And I was like, for someone who is just kind of breezing through this, you could have made a tremendous financial error right now if you did not select the magic word.
And to make it worse, just since we're talking about it, you're not allowed. You can ask the question all you want. The person on the other end of the phone is legally not allowed to answer, well, which one is better? Or which one should I choose? Or what would you tell me to do? Or whatever. They're not allowed to give any advice or say anything that would be a directive. They're only allowed to read from a script and tell you the definition of either or. So you could say, well, direct rollover sounds like what I want to do. What do you think? And they won't tell you. And so it doesn't help make the decision any easier.
And are they even allowed to say, like, you have to come up with 20% of the money or explain any of the consequences?
No, they're allowed to say you'll want to consult with your tax advisor before finishing this rollover request.
And is there any circumstance where anyone should select distribution instead of direct rollover? Because I can't think of one.
Well, you can say, I want the distribution, knowing that once the check comes to you, you're actually going to deposit it into an IRA within the 60-day window that allows it to still be tax deferred. However, most places will just withhold the tax on your behalf automatically. So you end up with 20% less going into that IRA until you go to file your taxes the following April. Looking at where we are in this year, you'd be waiting almost a full year to get that 20% back because you're going to have to get it as a refund from the IRS.
So anyway, my point of this is that I've just broadly been thinking about how saying or not saying the magic word can really help you or cost you in circumstances that may not be obvious to you.
You know who's really good at pointing out the magic word?
Who?
Little kids.
Yeah.
Like when you ask
Pee-wee
or tell
Herman.
them a question or give them something to do and they return to you literally what you asked them for or told them to do. And you're like, why would you do this? I said blah, blah, blah. And they're like, yeah, but you didn't say. Like, why would you put on those shoes when I told you go get shoes? And they're like, you said get shoes. And it's like, but you have on dress clothes. Why do you have on Nikes? Well, you said shoes. You didn't say dress shoes. So
I'm on the kid's side.
Yeah, the magic word becomes way more obvious to you when you're dealing with that kind of nonsense.
So, listener, if there is a time that you have said or not said the magic word and it has helped you or hurt you, I think of times where I've gotten a raise because I said the magic word, even though my performance was the same.
People might pay you to find out what that magic word is.
Send us an email, thistimepod@gmail.com. Let's not talk about it on the record. And but anyway, if you've had a time where you've said the magic word or not said the magic word and go, I can't believe that happened. Either email us at the email, thistimepod@gmail.com, or leave us a Spotify comment. I'm curious to see if this has happened in your life. Anyway, we got a lot to talk about. The market dumped on Friday. It was the worst day in the Nasdaq's history in 1 year. We have more SpaceX shenanigans to get into. And also, I want to talk broadly about the space economy. So Malcolm, the market dumped on Friday, dumped, D-U-M-P-E-D, not dunked, because the labor market added more jobs than the stock traders wanted them to. And it's in a good economy is bad for interest rates. But also, a jobs report should not be a micron earnings release in terms of like these whipsawing expectations. But that's exactly what happened. When I see these jobs report, my first instinct is that this means nothing because the average revision they make is close to 83,000 according to the BLS. So it always confounds me when traders, algorithms instantly make big decisions on a jobs report that may or may not be in the ballpark.
But I think you framed it right with the second word that you said. The algorithms have been pre-programmed to respond to BLS data, parsing through thousands of characters for a tiny little nugget of directive. How do I take action once this report comes out? And that probably needs to be tightened up better in the future. And so we saw computerized selling more than anything in response to that BLS report is my guess.
Yeah. And I heard from people who are like, oh, this makes me nervous. This stock drop. And you zoom out just a week or a month or a year and things are still on fire. But anytime the market dips even a little bit, I'm sure you hear from people like, uh-oh, this is a really bad sign.
Yeah. Yeah. But that's also what's weird about where the market is, where everybody's a day trader now. And so we're all acutely aware of things that are pretty mundane and really don't have any actionable impact on your life. Other than to say the government puts out this data every month and, hey, look at this data, and they compile it and aggregate it. And over time, the mountain chart says blah, blah, blah. But for people who are busy doing the thing that they do on a normal basis, like the doctor, the dentist, the coder, the whoever that's got a second screen up at all times focused on what the markets are doing and, is constantly placing trades throughout the day or placing, options strategies into all of that junk is the reason why this BLS report matters at the moment. But in a normal world where the market is just kind of doing what it does, it's not really on fire, but it's not negative or positive necessarily. Nobody cares. It's just there's so much data out there now that people are trying to convince themselves that professional traders like me should care about, because now I'm a professional trader, even though I went to school for 33 years to be a physician. I think that's more of what we're seeing.
Okay. And anytime that happens, and by the way, as we record on Monday, things are bouncing back. Nobody seems to be panicking anymore.
Yeah.
People were looking for reasons like, why are things selling off? And one reason that I saw in the Wall Street Journal is, people are nervous because now Google is selling stock to finance the AI build out.
Well, I don't think that's nonsense.
Okay.
There's two things that I think are responsible for last week's sell-off. One, I'm trying to get myself in position to go out and buy as much SpaceX as Elon Musk will sell me. That's the reason I think why Bitcoin fell from $73,000 per down to about $63,000 per within about 48 to 72 hours after they announced the date of the IPO. Bitcoin just plummeted. And I think that's why I got to pull cash from somewhere. And mind you, this IPO is going to be reliant on retail investors to buy up those shares. And so I think a lot of that
the IPO is also reliant on index funds buying up the shares because they're forced to.
And who owns those shares? Retail investors again.
Yeah.
Who owns the Qs?
But it's not individual people going out and buying this, I think, as much as a forced buying event.
Well, I think it's both because they said it's about 30% of the shares that are going to be available are earmarked for individual investors buying them through like a Robinhood or whatever else.
Okay.
So it's heavily individual investor focused. But then separately from that, Google saying we've got to issue equity, a new share issuance in order to come up with $80 billion over however many months is kind of a bad sign for a movement or a moment that's supposed to be built on. Look at how awesome it is that these companies are able to use their free cash flow that they're generating from AI to go invest in more AI. So their gross margins have grown, their revenues have grown, blah, 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 because AI. And so then they take those profits they've generated, buy more AI, and that's going to help us make more money with more AI in the future. And then, whoa, they got to raise $80 billion, and the only way they can do it is to sell more stock into the public markets. Oh, shoot. What does that actually mean? And I don't want to be the loser who goes into the weekend without an answer to that question. So I'm going to sell some shares of whatever now, and I can do some research over the weekend and decide if I still want to own that or not.
So I was saying earlier, though, that it just seems like whenever there's a sell-off, people immediately look for past reasons to lump in with the triggering event.
Yeah.
So I don't disagree with anything you're saying. And I think there is a broader question of, it sounds technical, but it's not. Why is Google issuing more equity and not issuing more debt to do this?
It's a balance sheet dance, really, more than anything that they need to do. So for context, Alphabet has, I don't remember the exact number, so, fact checkers, do with it what you will. But it's like $120 billion or so that Alphabet has on their books and cash-like investments. And they're raising $80 billion at the same time. So it might look, and also they just raised like 25 or so from a debt issuance that was like a 100-year bond they sold into the EU. And so it might look like to an average person that manages their household balance sheet, if you've got that much money and if you've got that much sitting in cash on the sidelines, why would you go take out debt? Because debt's expensive and you got to pay for it and whatever. But in reality, I think this is we've got to make hay while the sun is shining kind of thing.
Sure.
If they're willing to throw the additional cash at us, we're willing to take it, and we'll decide down the line how we deploy it. But we know we're going to need it. We're going to need that war chest at some point. And so we better raise the cash while we can.
And I also want to give you credit because you wrote about this. Everyone is saying Google is issuing shares to finance the AI build out, but also there's a much more boring reason they're doing that.
Well, boring and also to me, like I felt like Sherlock Holmes for a second because in the documents itself, I'm curious how much more room there is for additional buying. Debt raising. And I'm curious how much more firepower these companies actually have to throw more money into the ground to build out these data centers. And so what I'm looking for is cracks in the foundation that say Google, Meta, Microsoft, Amazon are approaching the end of their line to where on their next earnings call, they're coming out and saying, yes, we spent $180 billion last year, but we only see ourselves spending $90 billion this year coming. That is basically announcing the end of the party.
Yeah.
And I'm trying to find that. So anyway, inside of the issue docs, and that's also how I found out why I was paying attention to how much cash Google had on its balance sheet, because initially I'm thinking like these people are usually pretty cash heavy. Why do they need another $80 billion? And because they already have the cash, it's clear to me that it's just one of those things where, like, if you're willing to give it to us, we're willing to take it. So anyway,
if you want to give cash to this show, we'll take it. We'll promote your brand with no
we've got
exceptions.
standards. Okay. We've got to make sure your brand aligns with our brand and all the stuff, the media gurus will tell you to say.
Peptide companies, gambling companies, gold IRA things gold bullion for your IRA. Come on down. We're taking bidders.
But anyway, so not to bury the lead, the thing that I came up with that was interesting to me was that 40% of that $80 billion, 37 and change percent of that $80 billion is going to be going toward the tax bill related to the RSUs that this company issues. So they pay their employees in equity way more than they receive cash, salary, or bonus. So you think about the total compensation of a senior engineer who works for Alphabet, they probably earn something like $220,000 as base salary. They also receive a bonus of up to 25 or 30% of their base salary each year. And then the rest of it is what's called restricted stock units. That's equity compensation, shares of the company in lieu of cash, basically. And that's great for everybody. The employee who receives those shares gets to take the ride upward, assuming the company performs better over time than it did before. And so I get a call option on the value of the work that I'm doing today on behalf of the company. That's great. But for the business's perspective, for the CFO's perspective, we get to book that expense as a non-cash compensation for that employee, which looks great on all of our documents each quarter when earnings come out. And it looks great on our balance sheet, on our profit and loss statement, because it doesn't show as much as we would actually have to pay this person in cash compensation. It doesn't show the entire $500,000 this senior software engineer earned last year. But what also happens as a byproduct of that is we, the company, have to withhold 22% ordinary income tax on behalf of that employee, even though they receive shares of stock and not cash. So that 22% has to go into the IRS's coffers by the end of the calendar year that it's owed. And that's actual cash. The IRS won't let us pay them with stock. We do have to write a check for it. And what's happening is because as these companies are investing so much in AI, and that is growing the revenues of their businesses, and Wall Street is rewarding that spending and that increased revenue with the share price going up and to the right, the value of those shares is also going up and to the right. So the size of the check you have to write to the IRS on behalf of that employee that you're withholding taxes for is going up and to the right. And so do I want to come up with the money to pay the IRS, or do I want to come up with the money to build my next data center? Well, the answer is you got to do both. Yeah. And so part of this capital raise has been to fund the tax bill. And interestingly enough, as I started backtracking and pulling on this thread, a lot of the companies that are doing these massive layoffs, you have Amazon laid off like 20,000 people within, 12 months of each other. Sure. Microsoft with a pretty significant layoff, and then also an early retirement offer that came right behind it. Meta announced some pretty significant layoffs. These are also the companies, coincidentally, that are at the very forefront of the AI arms race and spending tens of billions of dollars to put shovels in the dirt to build data centers. And so it is very plausible that one of the reasons why we're doing these massive layoffs is not because AI is making us so much more productive and so much more profitable that we don't need all of these humans. It's that the cost of managing these giant stock plans is becoming such a burden to us that we need to get rid of some of the people to be able to afford the payroll taxes and the IRS tax withholding on behalf of the employees we're keeping.
I think I hadn't thought about it that way, and I appreciate you doing your digging. And we've talked about that with not just AI efficiency, but also the cost of debt now. Mm-hmm. It's much more expensive to take out debt for these companies to do their fantastic data center build outs, but I think that's a huge piece of it as well.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
Let's talk SpaceX. So last show we did the S1 and we kind of dug into the financials. This is the week of the IPO, so it's going to be a different conversation. The reason this particular show is coming out a day late is because I have a story that released this morning, this Wednesday, on The Indicator from Planet Money about the index rules for SpaceX. So as Malcolm has tried to make tax withholding interesting for you, I will now attempt to make index methodology interesting for you. This is the controversy, which is that Nasdaq introduced these fast entry rules a month before SpaceX's IPO. And it was reported, the Financial Times reported earlier this year that SpaceX was considering a June IPO because it is Elon Musk's birthday month. Or Elon Musk was saying it's because it's his birthday month and because this is when I think it's Venus and Jupiter will align in the night sky. And if it's not those two planets, it's like it's one of the two of the planets in our solar system are going to appear very close together. And if you look up at the night sky tonight, you will be able to see those two planets very close together. The more boring reason is that Nasdaq was considering a rule change, two rule changes. And so what the Nasdaq had been doing before is that they were existing as a float weighted index, or excuse me, a market cap weighted index. So if a tech company in the Nasdaq 100, which is their S&P 500, that's the QQQ, if they had 20% of their shares outstanding, they counted it like it was 100% of the shares outstanding. And so the Nasdaq ETFs had to represent just the market cap of these companies, not just how many shares are outstanding for the public. And that's what the S&P 500 does, which is just, hey, the shares you have outstanding for the public is how we count you in the S&P 500. So the Nasdaq had sort of a broken rule. It's sort of like a cliff vesting schedule, which is once you got to 10%, we count you at 100%. But the thing they did that kind of countered that was that they only updated the Nasdaq 100 once per year. So they had a meeting in December where we're going to add some new constituents and take them out. And you have to have been trading for at least 3 months on the exchange. So there was a very methodical way that companies entered and exited the NASDAQ 100 or the Qs. And so in order to fix this, they got rid of the cliff vesting thing. But this is the controversy. They added sort of a 3x multiplier on shares. So if you're a thinly traded stock in the NASDAQ 100, which affects SpaceX and then possibly Anthropic, OpenAI, the mega-IPOs coming, they said, we are going to weight your company like you have 3 times the number of shares outstanding. Mm-hmm. So when SpaceX goes public, they're issuing about 4% of their stock to the public, but the indexes will have to buy SpaceX stock like 12% of the shares are outstanding. And many observers have said that this creates a demand squeeze. Mm-hmm. And this means that retail investors who own these passive index funds are buying SpaceX at precisely the worst time, which is on the other end of a demand squeeze. And that's what the story is fundamentally about. The update is that the S&P 500 is standing firm in terms of float weighting, which I give them a lot of credit for. 10% is 10%. And the other part of this story that I want to share is that the NASDAQ did not want to talk to me. Mm-hmm. I had been trying to get an interview with them since March. I'd been going back and forth with their comms people. I had tried to book an interview. They would blow me off. I would send a list of questions, 3 questions. They responded to one of them with a published Q&A they did. And then eventually, as I got to the deadline for this story, We just said, I made it clear and they agreed. We're going to decline to answer 2 of your questions, and we're going to make nobody available for comment for a fairly large business and economics show. So sure. I think that is significant.
Well, I'll give you the other side of that. I have no inside information to any of this, by the way. I'm just speculating based on how I know things work. And I'm thinking about the fact that the Nasdaq and the New York Stock Exchange have been battling over IPOs since the beginning of whatever. And the Nasdaq typically takes on the bigger tech IPOs and the bigger tech related companies and whatever, because that's just where they go. But at a time when we've gone from 8,000 or so publicly traded companies down to about 3,600 maybe. So we've more than 50% fewer publicly traded companies. And also these companies are taking a lot longer to go public than they used to, which means you have far fewer IPOs just based on volume every single year. Every single one of these IPOs matters if you're the NASDAQ and the NYSE. And so it's not that surprising to me that a company that makes the majority of its revenue based on these blockbuster IPOs that we're having when a decacorn finally decides it's ready to go public.
Decacorn.
You've got to do what it takes to get that business, because you're only going to get 4 of them this year, maybe. Cerebras, SpaceX, Anthropic, OpenAI. And I personally am still not even convinced all 3 of those yet to be debuted are going to make it out. So sure. You're looking at this and you're saying, listen, we got to do what we got to do. We need to be in the Elon Musk business. There will not be another $2 trillion IPO. Forget in my lifetime, in my career as an executive of the NASDAQ, I'll say.
Yeah.
And so I got to do what I got to do to satisfy this dude's wildest requests to make sure that his IPO doesn't fall flat on his face, because it is the Elon Musk Inc. IPO. And so I want to make sure that its namesake doesn't look bad. That's really what he's caring about and structuring everything the way that he is. And I'll say also one more thing in support of Elon Musk. I know there's going to be a gasp on the other side of this when the listener hears that I have something to say in support of Elon Musk. But I'm just thinking, what else should I be doing if I'm the wealthiest man in the world? Like, wouldn't I want to rig the system so that it works out in my favor because I have more resources than God at this point? And like, if I got $300 billion to my name and can do whatever I want to do, why wouldn't I bully the major indexes into figuring out a way to make it so that I only have to give up 5% of the shares in order to get guaranteed floor under the pricing on this IPO and everything else?
Well, we'll never know the NASDAQ's reasoning because they didn't want to speak to me on the record with
I mean, I'm speculating.
I think that speculation could make some sense, which is, hey, we're the technology index and we want to get the big tech companies here. So occasionally we have to crack some skulls and maybe everything will turn out all right once things are in the index and settle down. And by the way, I appreciate you saying something about positive about Elon Musk. He is the richest person in the world, and he is trying to build data centers in space. He is not trying to buy up dentistry clinics throughout the Midwest and then squeeze out a little bit more profit while making the services worse for you and charging you surprise billing. So I've given him credit for doing that as well.
You say that until the space trash starts landing on our heads.
The space trash? You said space trash and space junk. Okay. Do you know how much bigger?
No, space trash is a technical term. That's a real thing and problem that exists.
But do you know how much larger the just not circumference, but just like the surface area is in space to avoid space trash?
No, but there's still a lot of trash that's floating around up there. Okay. In low Earth orbit space, is it the Carmine line? I think that's the first layer when you get technically into outer space. When you get to that, there's a lot of our trash in the form of decommissioned satellites and all that crap that is just floating out there serving no purpose right now. It's just a hunk of metal clouding our skies and the reason we can't see stars anymore in major cities. It's just space trash.
Malcolm has no idea what he's talking about. There's light pollution. The surface area is much greater. Space is still very open. Let's concern troll about the ocean.
And space trash.
The space trash is the biggest problem facing the market right now. The other part of this story that I thought is relevant. So I had Campbell Harvey on. He is a Duke professor, and his claim to fame is that he came up with the inverted yield curve as a something that can predict recessions. Mm-hmm. So basically, that when long-term interest rates are more expensive than short-term interest rates, so people are more pessimistic about debt in the short term than the very long term, that can be an indicator of recessions. It's something that is like very popular in financial media. He has a lot of other economic ideas. And one of the things that he wrote on LinkedIn about this IPO is that it just reveals the deeper issue, which is that pretty much only wealthy investors, accredited investors, VCs, have been able to participate in the growth of these decacorns like SpaceX, OpenAI, Anthropic, and retail only gets to come in at the IPO. And that this accredited investor rule is totally outdated when the internet exists and when AI exists. And you could simply do a quiz to see if you know what you're talking about a little bit and be able to buy equity in these companies at a much earlier time. And maybe they have to do like one financial report a year or something. But we're starting to see the cracks in this rule from 1933 that has prevented the vast majority of people from being able to get in on these stories a little bit earlier. And now here they are at possibly the worst possible time, which is when the demand is juiced by these rule changes and we're already at $2 trillion.
I don't agree anyway that is how you root out this problem of access.
Sure.
There is no shortage of informed retail investors who could pass any mundane quiz you put in front of them to prove that they're worthy and safe enough to be able to invest in a company that could blow up on re-entry to the earth 99% of the time, right? And they have the financial wherewithal to sustain any of these moonshots not working out and being just fine. The access problem is still the fact that a company doesn't have to go public until the juice has already been squeezed out of that lemon to death. If you just look at Anthropic, for example, just raised another $60 billion, I think it was, in this latest funding round.
Sure.
Less than 12 months after they did a raise just before that. And they didn't really need to do that raise necessarily either. It kind of goes back to what I was saying before. If they'll throw the money at me, I will gladly take it. But separately from that, if you looked at who came in on that investment round, it wasn't the usual suspects like an Andreessen Horowitz or a Greylock or any of those guys that are like Series B, C, D. They're throwing in 8-figure checks and crowding out everybody else. They'll take the entire funding round themselves. This was like Fidelity. This was like gigantic institutions that have so much money that you and I wouldn't be able to participate if we wanted to, right? And so I think there is a misalignment with who to point the finger at and where to place the blame for this.
Sure.
And I think that the problem is there's no incentive for companies to come public. And that might be what we need to figure out a solution to. I don't have to deal with the SEC. I don't have to deal with analysts asking me uncomfortable questions on earnings calls every quarter. I don't have to deal with as much of a regulatory burden and a compliance burden and, making sure our financial documents are buttoned up tight and all that kind of stuff. I don't have to worry about my comms as much as a public company. Like all those things that people are, I won't say afraid of, but annoyed by. They don't have to deal with because there's so much private money that's willing to back you and deal with the idiosyncrasies of dealing with a founder who just wants to do what they want to do. And so I think there has to be a way to incentivize companies. Once you reached $1 billion status, once you're a unicorn, we should have a way to incentivize that $1 billion company to IPO and not turn into a $10 billion company. God forbid a $2 trillion company in private standing. Because there's a list I saw recently of how many millionaires have been made based on proximity to Elon Musk and SpaceX. And it's like 275 individual people. That's crazy. Like, those aren't employees and long-standing employees who helped build the company or even board members. These are just individual people who have access to Elon Musk enough to write him a check for $1 million or something. And now they, on the other side, are going to receive like $100 million on that investment because they had proximity to the guy running the company. But like, there should be some kind of incentive that you just hit $1 billion valuation, you need to go public tomorrow.
I think the incentive is that this was something Trump floated in September of last year, which was, this was on Truth Social. Did you ever hear the statement that China has a 500 to 100 year view on management of a company, whereas we run our companies on a quarterly basis? Not good. And I think there's something to that. In Europe, you can report twice a year. If you're a young company, I think that, and the other thing too, if you report your financial results, you do not have to do a quarterly call. You don't have to do a call. Mm-hmm. There's no requirement to do that. That's just tradition. And so I do think you're absolutely right. And I think the way you do that is you allow companies to report on a 6-month basis. They do that in Europe. If you want to, you can report on, you report on a 6-month basis. You can do a quarterly basis if you want to. But if you're a young company and it's a pain in the neck and you're just like, why is my CEO on the phone with JP Morgan analysts who are just trying to get that CEO to help those analysts fill in an Excel model about the valuation of their company? I mean, I get it. Just, hey, tell us how your company is doing twice a year. And you can do a long form podcast. You can do a call. You can do nothing if you want to. And that's how you incentivize them to go public, maybe, or you get more.
I don't know if that's enough.
You don't think it's enough?
I've taken away 2 out of 4 uncomfortable conference calls for you. Is that enough to convince you that you should go public at $1 billion or $10 billion valuation rather than waiting until you hit $1 trillion? I don't know that that's enough to get anybody excited.
Your only other option is like tax breaks then.
Yeah, and that's not going to fly either. So I'm saying this without also providing the solution. I don't know what the solution here is.
You're just heckling.
But I just feel like we're approaching this from the absolute worst possible angle, which is wagging our finger at the folks who have made money this way and saying, you are the problem. You shouldn't be allowed to make money out of investing privately in SpaceX. Shame on you. Yeah. And I think it's more so that there should be some sort of incentive to make it so that the founders and the financial team at SpaceX has no choice but to do it this way.
Okay.
Because why wouldn't we?
So Malcolm's a communist. And the other part of this story I know you wanted to talk about, I'm less angry about, is there are people in the Trump administration that have shares in OpenAI and SpaceX. I mean, yeah, it's Steve Witkoff. All right. Small Business Administration head. I can't keep getting angry about stuff. I mean, U.S. ambassadors to Ireland, the Czech Republic, and Portugal have also reported stakes in SpaceX. If the ambassador to the Czech Republic wants to get their beak wet, I mean, we got bigger problems, Malcolm.
Well, I think, though, what we do have to pay attention to is the idea, once again, that our country and access to the people leading our country are for sale.
Yeah.
Because I have to imagine that part of the roadshow once upon a time before the bromance broke up, when Elon Musk was traveling on Air Force One and a part of all these presidential addresses from the Oval Office and all that, there's conversations being had around like, do what we want you to do, be nice to us, and Elon will let you in on SpaceX. Like, I have to imagine that those kinds of one-for-one exist because they've existed in all these other different ways with like the crypto tokens and, the U.S. government taking a direct ownership share of these different companies and all those kinds of, we're taking 25% VIG on all of the chips that NVIDIA sells in China, like all these different, like very crookedy, like leaning deals, let's call them for lack of a better term. This seems potentially like one more of those kinds of things where the people ended up with shares because they had access, because they're trying to manipulate some other function of the government, and the U.S. is for sale, basically.
The dark part of this is I read this and I'm like, man, I want to be an ambassador to like a country we don't have huge issues with. Like, don't give me a country that we're in conflict with. Don't give me like a massive country where you have to go to a lot of meetings. But ambassador to the Czech Republic, that doesn't seem so bad. I like going to Japan.
It would be hard to find a country we don't have beef with by 2028.
By 2028, okay. Then small beef, less beef you don't hear about in the news. That's also a fun place to visit and preferably kind of warm, not too cold. I would do Iceland. I just wouldn't go there in the winter. Anyway.
Get ready for Nepal.
The other part of this is I want to respond to a question that Alex Tran asked us on Spotify. He asked me about Rocket Lab. That was one of my greatest hits in terms of stocks that I had been positive about when I was positive about Rocket Lab when it was close to $1 billion valuation a few years ago. I've trimmed my position. I believe in the story long term. I think there are more underappreciated stories right now that I want to put money into better than this. We've talked, Malcolm has sold me on the software trade. I've talked about gold. I've talked about real estate. And so that's just where I've been putting dollars. And also just with Rocket Lab, I think it's a tremendous company. I still believe that there is a place for a launch provider that is not tied to Elon Musk. If you need a launch provider, this is your other option. This is your primary other option. The business is doing well. They have a 100% increase in backlog orders. It's from one customer. Rocket Lab won't tell you who it is. But the other thing that I've been looking at is just valuation. The company is now at close to 100 times sales. So a lot of that growth is baked in. And, Jeremy Siegel, Jeremy Schwartz, they did stocks for the long run. Once price to sales gets above 40, so just we're valuing a company at 40 times the revenue they've brought in as a public company, it's really hard to outperform over a long period of time. And maybe this one is different, but once you start getting to those nosebleed valuations, when especially the thesis a few years ago was this company is underappreciated, maybe now it's properly appreciated, and 100 times sales makes me a little itchy, and that's why I've trimmed.
This is what I think makes sense here. I actually started doing this myself personally on the train back home from New York a couple weeks ago. I'm writing down and taking notes on all of the themes and the things that I feel very strongly about from an investor perspective today, and then filing them away to revisit it in a year or two when people don't feel so great about this market anymore. Because something like AST Space Mobile or Rocket Lab or even like Joby Aviation or Archer or whichever one of those is those kinds of things that we're really excited and they're just flying right now, they'll still be doing really good work later when the market cools. They'll just be doing it quietly when there's less eyeballs on them. And that's where I want to enter those stocks. So I do want to own companies that are targeting the space economy because I believe there's some there. I don't want to own it at this entry point. So but a year or two from now, when everything's cooled off and we're not talking about that anymore, and we're following along with what the energy companies are doing or what some manufacturing and mining and maybe the real estate sector is leading the S&P at that point or whatever, we'll forget all about this moment, but there's still really good companies under the surface that I want to make sure I don't lose sight of. And that's sort of what I'm building this list around to remind myself of when it ain't so hot.
I think that's a great idea. And I mean, you've also talked about it on CNBC where you're just like, I think you basically said now's not the time to go chasing.
Yeah, I'm basically just accumulating cash to try and make some of these larger entry positions, but not anywhere close to. I just saw something, I think it was Goldman Sachs increased their year-end S&P target to 8,400 or something like that. It is just freaking silly town. We just were celebrating S&P 7,000. And now we're talking about realistically 8,400 before this calendar year is over. Like, it's just getting nuts. And so I'll wait until it all comes crashing back down to earth in the 6,000 range. Maybe I get lucky and we sell off even further than that, and I can really start to build a legitimate position in these companies that are doing something at reasonable valuations again.
I'm also just so used to blowing off price predictions from investment banks. Like, people treat them as a news story, but they don't. Like, you can't do that. You're forecasting the weather 6 months from now.
No, they're required to. It's part of the job. They hate doing it too.
Yeah.
I'm painting with a broad brush, but anybody I've ever talked to about their price target, they hate having to do it.
A few weeks ago, I was talking about my obsession with arena football. Just a quick note, Malcolm, I actually went to a game.
I know. I've seen the photos. You look really happy to be there.
It was, I realized, I was like, I'm having so much fun here, and this should be illegal. So it's I was a National Arena League game in Denver, Colorado. Went with a couple of friends. And first half, it's a really slow thing. It was like over 3 hours. They were doing media breaks, and I was like, this is going on way too long. And so we're kind of sitting up in the stands, and we start to get bored, talk about leaving in the third quarter. But then after halftime, we realized that you could just walk down next to the field. So we went from the field being like 40 feet away from us to about 6 inches away from us. And when you get to the field, they let you hold the down marker. And so you can participate in it. They're coming flying at you. You got to watch out and make sure a 350 pound offensive lineman is not coming flying over you to take it. There are kids down there, which I thought was
Do you have to sign
dangerous.
a waiver?
No.
And to see that, like,
that's called assumption of risk.
But like, you're standing there with like a referee looking shirt on, so they might mistake you and come flying over the wall and think you're just part of you'll move. You know what to do.
Well, the mistake I made too is they gave me the down marker, and it was the ball started on the 20-yard line, which arena is 20 to 20. And they give me the down marker, and they had placed it a little further away from the 20-yard line. And I thought that Colorado was on offense. So I thought that they were trying to give the Colorado team a few extra inches for they were making the first down a little bit longer. It's these high school kids. One of them's missing a tooth. And he hands me the down marker for the first down. And I just go, absolutely not. We are keeping this like, we're being exact with this. I'm not giving a few extra inches. And so I put it on the 20-yard line exactly versus a little further out. And then I realized that the other team was on offense. So I was actually giving a few inches of yardage back to the Salina Liberty, and I felt awful about it. Like, during the game, I was like, hey, I know I screwed up. Like, I promise I'll do better. I'm here to support Colorado. And anyway.
You're never going to get invited back. Don't worry.
Oh, I'm invited back. I'm going back close to the field. And I did realize, though, like, it sounds silly, how violent football is when you're 6 inches away from it versus in the stands a little bit, and you're like, ooh. Like, I've been to mixed martial arts fights, and I felt better there than some of the hits I saw at arena football.
And these are the guys that didn't make it to the NFL. So imagine how violent the collisions are when you're talking about the best of the best.
All right. If you like the show, make sure you are following it. Rating it on a place like Apple Podcasts also helps us out. You can find Malcolm at Malcolm on Money on various social media platforms. You can find me at Rick's So Slick. Appreciate you staying with us, and we'll see you next week.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.